In this video, we're going to examine the relative risks and profits from investing in call options on a stock versus the stock itself. As our example, we're going to look at Tesla Corporation, which was trading at the point of this ticker quote at $1,017. Here is a list of call options on Tesla with strike prices ranging from $1,000 to $1,030. So the price that is closest to the current stock price is $1,015, the closest to being at the money. It has a current bid of 66, an ask of 67.4, and the last time a option was sold with this ticker was at 66.95. Note with calls, of course, you want to buy low and sell high, so the price of the call increases as the strike price decreases. The open interest is listed over here and the most recent volume. So we're going to consider an investor that invests $100,425 to either buy 15 calls with the last price of $66.95 and the strike of $1,015, or invests all of that money in Tesla stock at the price of $1,017.03, which will give them 98.7434 shares. For simplicity, we're going to assume that you can buy fractional shares. We will then figure out how to graph out the profit from investing in the call here versus the profit from investing in the stock here. So here are our final stock prices considered on the day of expiration of the call. We're going to look at potential stock prices ranging from 1,000 to around 1,140. Of course, the stock price could be higher or lower than that. Calculating the profit from investing in the stock is relatively simple. It's just going to be the stock price minus the strike price times the number of shares. For example, right here, we are going to have the strike price as being 1,015, as it always is, and then S, the stock price, is 1,000. The number of shares is calculated over here, and again, 98.734. And of course, at 1,000, the stock price will have dropped, and our investor will have lost $1,481. They will break even right in this range around where the stock price is the same price they have purchased it for, rounding a little bit, and above that our stock investor will have made money up to our maximum around $12,000. It is more complicated to calculate the profits from investing in the call, and of course they are a lot more volatile. So the profits from investing in the call, well, each time you purchase a call option, it actually covers 100 shares of the underlying stock. So you're going to get 100 times the number of calls, which is 15. And then the price that you pay for that is that number times minus C naught, where C naught is the call price, our 66.95. That then is the cost. The payoff is going to be either 0 if our call option expires out of the money, or S minus X if our call option expires in the money. So that would be the condition of the stock price being above the strike price. So our strike price is 1,015. We would need the stock price to be above 1,015, or right in this range before it is in the money. So below that, we will lose all of our profits. So our total profit from investing in this is going to be 100 times the number of calls times minus C naught, the call premium, plus the maximum of stock price minus strike price, are 0. And we calculate this again for all of our different stock prices. In this region, when we are out of the money, when we are below the strike price of 1,015, we lose all of our money, all 100,425. We don't lose as much of it when we start to get above the strike price, but we're still losing most of the money, and we don't break even until we get into this range right here. It looks like somewhere between 1,080 and 1,085, and then we start to make a profit on the call options. And of course, as we get into the high stock prices, we make a lot more on the call options as we do on the stock investment. So with the call option, you either make a lot more money if the stock price goes up, or lose all of your money if the stock price stays the same or goes down. And you can see this graphically. Here, our red line is the price or the profit from investing in the stock, and it's pretty flat, doesn't vary a lot. So the stock prices go along here, and our profit goes along here. And this is relatively flat, certainly compared to the call premium. Again, if we are below the 1,015 of the strike price, which is right here, we lose all 100,425 investing in the call. If our stock price is slightly above the strike price, then we don't lose all the money, and we break even sometime in here and start to make more than the stock up in this region. We can also calculate those exact break-even points, and we can do that first for the break-even for the call option, and then for the break-even point for the call versus the stock. So the break-even point for the call option, we would set the profit for the call, which again is our 100 times the number of call options we bought times minus C0 plus max S minus X comma 0. If we set that equal to 0, then we can solve for the stock price at break-even. This doesn't matter, you can leave it off, and then we would just have minus C0 plus S minus X comma 0 equals 0. This is just going to be this part here. Solving for S, we get X plus C0, and X plus C0 is 1,015 plus 66.95. Our break-even point for investing in the call is 1,081.95. So again, if we look at the call, it goes from negative to positive between these two, and exactly at 1,081.95. The equation for figuring out the break-even point of when you would make the same amount of money for investing in the stock versus the call is more complex. We have to set this equation equal to this equation, and we end up with this long thing here, 100 times the number of call options times minus C0 plus maximum of S minus X comma 0 equals the number of stocks we buy times S minus X. So again, for it to break even, the max has to give us the S minus X. We don't have the 0, so we end up with this equation equals to this equation. We can divide both sides by the number of stock options here, and we can define this ratio here as our R, 100 times the number of call options divided by the number of stock options. So 100 times the number of call options at 66.95 divided by the number of stock options at 98.7434, and we get here that calculation of 15.1908. If we then further rearrange this equation, we can solve for S. The steps in doing that, we would start with, here we have R times minus C0 plus S minus X equals S minus X. We could pull the S minus X to this side, pull the C0 to this side, and we'll end up with R minus 1 times S minus X equals R times C0. Solving for S, we get then the strike price plus the ratio of R over R minus 1 times C0, are $1,000 and roughly $1,087. And you can see the point at which you go from the stock making you more money to the call option making you more money is between these two. At this point, you have the 6,912, which is greater than the 4,575, so you're better off in the stock. But just at a little bit higher price, you are better off in the option because 12,075 is bigger than 7,040, roughly 6. And that exact break-even point is again 1,086.67. I thank you for watching this video.